I'd like to thank you all for joining this evening. My name is Douglas Arner. I'm the Kerry Holdings Professor in Law at the University of Hong Kong. And I've been asked to speak about something that is impacting on all of our lives, and that is FinTech, financial technology. And effectively, what I want to suggest is that not only are we seeing technology transforming finance, transforming particularly in this region, but we have the potential today, as has already been done in mainland China, as is being done in India and elsewhere, to transform our financial systems going forward. And I think when we talk about this idea of FinTech, FinTech is financial technology. And when we think about financial technology, it is something that there are a lot of different definitions. For me, I take a very, very wide view of what FinTech is. And when we think about financial technology, the idea is that this is not a new trend. If we think about finance and technology, the two have always been interconnected. Think about coins. Coins are a technology to represent value, which can be easily transferred from one person to another. That technology is one of the oldest technologies in civilization. Think about accounting. Mechanisms for recording value that go to the very base of agricultural societies. And of course, today, what is the most recent version of coins? Cryptocurrencies. Things like Bitcoin, Ethereum, blockchain-based technological structures. The idea of the interaction of finance and technology is not new. What we are seeing today when we think about FinTech is really the interrelationship of three major different trends. The first is a long-term transformation which has been taking place in developed global financial markets, certainly since the 1960s. Why do I use the 1960s? Well, the world's first ATM was launched by Barclays in 1967. If we think about another thing that was launched in 1967, something that when I was growing up, Hong Kong was very famous for, the handheld calculator. First handheld calculator, 1967. Combination of the ATM and the handheld calculator, these were transformative technologies for finance. What do we see at the beginning of the 1970s? Beginning of the 1970s, we see the establishment of NASDAQ. NASDAQ was the world's first fully electronic securities exchange. Today, try to find a person trading shares on an exchange floor. They are almost extinct. Of course, only last year did Hong Kong finally close our physical trading floor. Likewise, SWIFT. SWIFT is the interconnection system for global cross-border electronic payments. SWIFT is the underlying infrastructure for over $5 trillion of payment transactions which take place on a global basis today. By the 1980s, the 1987 market crash, in retrospect, our best explanation of that crash, program trading. What is program trading? Program trading, computerized buy and sell orders. So already by the 1980s, do we have a big impact of technology in the trading market. Some of you will know by the 1990s, the advent of value at risk, VAR, quantitative modeling techniques, led to an explosion in hiring by large financial institutions of STEM graduates, computer science, physics, mathematics, which is, in many ways, the first round of FinTech. Of course, all of this culminates in the dot-com bubble of 1999, 20 years ago. That's one trend, a long-term trend of global technological transformation in traditional markets. A second major trend is the most high-profile one. The most high-profile aspect of FinTech for many people today are startups. There's been an explosion of new FinTech startups over the past 10 years. But even FinTech startups are not a new thing. Think about Bloomberg. Michael Bloomberg in the 1970s was in IT and Salomon Brothers, an investment bank. He left with seed funding from Salomon Brothers to establish Bloomberg in the early 1980s. Think about PayPal. PayPal in the 1990s was a startup. PayPal today is one of the world's biggest payment services firms. So even in startups, this is not a new trend, but we have certainly seen a very exciting explosion in startups, particularly as a result of the 2008 global financial crisis. 2008 global financial crisis breaks trust in the global financial system, brings massive changes from a regulatory standpoint, and lots of job losses to the industry. Lots of people leaving the financial services industry, looking for new opportunities. Many of them started FinTech startups, and that has led a huge new wave of entrants. The third big trend is developing countries and emerging markets. We think of a transformative piece of technology. A transformative piece of technology, this. Just over 10 years ago, 2007, was the launch of the iPhone. Now, in many developing countries, perhaps the transformative technology from the financial standpoint has been the mobile phone. Mobile payment services which connected literally hundreds of millions, billions of people for the first time to the formal financial system. All of these trends have come together no place more clearly than in mainland China. Mainland China, over the past 10 years, has seen a complete transformation of its financial system as a result of technology. And if we look at the combination of these three major areas, developed markets, developing countries, and startups, finance and technology are not new. But two things are new this time around. The first is the new entrants. New entrants from developing countries, emerging markets. Think, for instance, of Lufax or other forms of tech startups from not only developed countries, but emerging markets. The other thing that is different is speed of change. The speed with which technology is changing the financial sector, we've never seen anything like this before. And this, if we think about the Asian context, this transformation is happening here more rapidly than anywhere else because throughout much of the region, a very particular combination. That is high smartphone penetration rates combined with relatively inefficient traditional banking and financial systems. This, if we look at mainland China, was the most powerful combination that supported the transformation. We're seeing similar transformations spreading across India, Indonesia, Vietnam, the Philippines, Bangladesh, and beyond. And, as I'm going to suggest, a new trend to join these previous three is one which we call TechFin. TechFin is the entry of large technology companies into finance. And once again, it is the mainland Chinese firms, Alibaba, Tencent, and their subsidiaries, Ant Financial and WeBank, that are leading the way. But certainly they're not the only ones. Amazon today in the United States has become one of the largest small business lenders. Facebook, via WhatsApp, has become one of the largest electronic payment services providers in India. There is an emerging competition between these tech majors as they enter into more and more areas of financial services. The speed and the new entrants pose a very particular challenge. What we call this movement from too small to care to too big to fail in record time. Perhaps the best example of this is a money market mutual fund called Yuabao, established by Alibaba less than 5 years ago. In less than 1 year, Yuabao went from $0 in assets under management to $100 billion in assets under management. Less than 1 year. Today, Yuabao is the world's largest money market mutual fund. That is too small to care to too big to fail in record time. Last year, a new online bank was opened by one of South Korea's largest internet firms. It opened on Friday, and by Monday, it had almost 1 million customers. That's 0 to 1 million, too small to care to too large to ignore in a weekend. And this speed of change brings with it a wide range of challenges from a regulatory standpoint. At the end of the day, this technological transformation brings massive potential benefits, but it also raises massive potential risks. And we are seeing a range of approaches from a regulatory standpoint to try to deal with these challenges. And it's a particularly difficult problem because prior to 2008, we had a very positive attitude towards financial innovation. After 2008, we took on a much more cautious approach to financial innovation. Things like asset-backed securities, CDOs, credit derivatives, all of these sorts of instruments have been subsequently blamed for the global financial crisis, and as a result, policymakers and regulators, including here as a result of the mini-bond issues, have become very, very conservative in approaches. And they have been faced with a challenge: how to balance the potential opportunities with concerns about risks that may arise. And one aspect that we're beginning to see is the idea of RegTech. RegTech, or regulatory technology, is the idea of using technology for regulatory purposes. So if we think of RegTech, 3 areas that we're seeing it. The first is perhaps the most obvious to many of us. If we think about the financial industry, one of the biggest costs in the financial services industry is regulation, compliance costs. We think of, since 2008, there have been over $300 billion in fines levied against financial institutions for regulatory violations. This has caused a massive increase in spending on staff and compliance in financial institutions. Likewise, we have seen a massive explosion in the numbers of regulations that large financial institutions have to deal with. For a large global firm, like an HSBC or a Goldman Sachs, they will literally have to file 3,000 to 4,000 reports every single day with multiple regulators around the world. Perhaps my favorite example is a form that has to be filed every day in the United States with the US Federal Reserve form. That is a form on liquidity. Essentially, that form is 125 pages long. It has to be filed on a T+2 basis. So 2 days after the fact, the completed form must be filed. The US Congressional Budget Office's own estimates of the time taken to fill out this form are several hundred hours. That means that every day you have to fill out a 125-page form that takes several hundred hours, and you have to do it within 2 days of each day happening. The only way you can do this is through the application of technology. And as a result, financial institutions around the world have for a long period of time and continue to be the largest single industry spending on technology. And compliance and regulation is a major driver of this. The consequence of this, though, is that increasingly regulators are also having to use technology to deal with their regulatory responsibilities. If you think of the firms filing thousands of reports, the reality is the regulators are getting thousands of reports. And certainly there are very substantiated jokes about warehousefuls of suspicious transaction reports done as part of the anti-money laundering process that no one has ever looked at. And from the standpoint of a regulator which is taking this effort from the standpoint of the industry to make these filings, it is really incumbent on regulators to use them. And I think if we think of an example, Merrill Lynch in October was fined for failing to report 73.5 million exchange-traded derivatives transactions over a 2-year period. That breaks down to roughly 150,000 trades every single business day for 2 years. Now, you can't, as a financial institution, do that sort of reporting without automation of functions. And likewise, that sort of reporting is completely useless to regulators if they do not have their own sophisticated data analytics capabilities. And this is very much the direction that we're seeing. Now, is this idea of regulators using technology a sort of ivory tower fantasy? Well, in fact, think about something that most of us are familiar with. The idea of insider dealing. Insider dealing in the United States, the single most common time insider dealing takes place is before the announcement of a major corporate event like a merger or acquisition. Since the 1980s, the primary source of insider dealing enforcement actions in the United States has been the electronic trading tape of the exchange. What do? Merger announced on day X. You take 6 months of trading data, cross-reference it to the insider list of directors and their families, and look for any unusual trading behavior. If there is, that is how you commence an investigation. That is regulatory technology. That is regulators using technology to better achieve their regulatory mandates. Today, we're seeing it big data generally. We're seeing it in particular in an aspect called macroprudential policy. Central banks and banking regulators tasked to try to prevent the next crisis, looking at massive amounts of data to try to identify potential problems before they arise. The downside of all of this technology is this: cybersecurity. Cybersecurity today is probably the single biggest risk to financial stability that we see. It is one of the most difficult to deal with, both from the standpoint of individual jurisdictions as well as from a cross-border basis. But we can actually go beyond this, and we're beginning to do this in a number of areas, where instead of just use for compliance purposes or use for regulatory purposes, we can look at how can we perhaps redesign systems to function better. I use a quote from Andy Haldane, the chief economist of the Bank of England, who uses a sort of Star Trek analogy for the sorts of graphic views that regulators are not looking for, but they're increasingly using in the context of their activities to identify risks and issues. The idea is that FinTech requires RegTech. And beyond this, we can think about designing systems. This idea of designing a digitally smart regulatory system. In other words, if we think of, from a finance academic standpoint, one of the most important databases is a database called EDGAR. EDGAR is the filing system for all U.S. public companies run by the U.S. SEC. It's perhaps the most powerful investment tool in U.S. markets. It's also one of the most powerful academic tools. EDGAR is based on the idea of digital submission of documents, so that they come in, they go straight into the EDGAR database, and they are available both to the SEC as well as to the industry, as well as to academics, in machine-readable formats, which facilitates the immediate analysis of that data. As we think about not filling in handwritten forms, but we think about building digital systems in order to accumulate data which can be better analyzed, this is an area where the TechFins in the mainland are driving it. They are doing hundreds of millions of transactions in any given day, and they want to simplify their processes. Another example, last week, the managing director of the MAS, the Monetary Authority of Singapore, announced that going forward, financial institutions would not be required to report the same data point twice. How do you do that? You build a data catalog of all of the information that you're collecting, and you eliminate double entries. That is smart regulation, digitization, datafication. From a design standpoint, the most influential example is India. India, looking at the transformation that has taken place in China, realized that from a competitiveness standpoint, it needed to do something. And it built a strategy, what is called India Stack. The India Stack strategy is built on 4 pillars. And keep this in mind as you think about Hong Kong. India, of course, is almost 1.3 billion people. We're roughly 7 million. Base part, digital biometric ID. Over the past 10 years, India has rolled out more than 1 billion digital biometric ID cards. Combine that with an open API payment system in the banking system, means that new entrants, new participants can easily get access to electronic payments. Third level, a strategy of opening bank accounts. Over the past 5 years, India has opened more than 350 million new bank accounts, more than the population of the United States in terms of new bank accounts. And more recently, the creation of a digital KYC, Know Your Customer, data wallet, which means that in India, an individual customer doesn't take, as it does in Hong Kong, a month to get a rejection. In India, you can open an account in less than a minute. Now, that is building financial infrastructure. Now, impact, certainly as a result of a demonetization experiment last year, India has gone from a small number of digital payments participants to large numbers. Paytm, which is actually a subsidiary of Ant Financial in India, 2 years ago had about 15 million customers. Today it has over 200 million. That is an explosive expansion in digitization. Assets under management in the securities industry, retail assets under management, went up by over 100% in 1 year. Why? Because with this system, it becomes economic to use automated robo-advisory systems to onboard securities clients who only are able to put in a small amount of money each week. In Hong Kong, the costs of onboarding a customer mean that a customer really has to have quite a substantial amount of money to make the acquisition of that individual customer worthwhile. This transformative from an inclusion system. Another design, and this one's a little bit by accident, what I call EU Big Bang 2. EU Big Bang 2 is the combination of 3 things that are, for those of you in the financial services industry, already making your life difficult. One, MiFID II, the Markets in Financial Instruments Directive, which basically requires reporting by firms like Merrill Lynch of all of the millions of transactions that they're doing every day, transparency. The Payment Services Directive 2, which opens bank data and information to new competitors. In other words, as a result of PSD2 in the EU, banks with EU licenses cannot tell a new startup that they can't have data from a customer if that customer tells them to do so. And the General Data Protection Regulation. This is something that was designed largely as a reaction to the US data giants, Microsoft, Google, Facebook, and the like, to give individual control over data. The combination of these three is likewise in the process of fundamentally transforming EU financial services. So, building financial infrastructure. Where are we seeing this? Clearing and settlement. ASX, Australian Stock Exchange, announced earlier this year that it's replacing its aging settlement system with a blockchain-based system. Payment services. SWIFT is in the process of rebuilding the global payment structure as a result of a few little hacks and some frauds that cost the US Federal Reserve and the Central Bank of Bangladesh rather large amounts of money. Cryptocurrencies, data storage, transfer, and protection, and something that we're having an event on tomorrow morning, ICOs. Looking forward, what sorts of issues do we see? One, things like ICOs are getting a lot of attention. They're interesting in some ways, but at the same time, they're also interesting because the blockchain-based structure, from the standpoint of financing early-stage businesses, has a lot of advantages in terms of transparency and potential liquidity. And as a result, even though a lot of what we're seeing in the ICO markets is a complete mess, there is underlying that something very interesting. Cybersecurity, I've mentioned. TechFin is something that regulators are trying to grapple with. Think about the issues with Facebook over the past week. Now, in the context of financial services, these sorts of data problems are a very difficult topic to come to terms with. And in particular, from a big picture standpoint, the relationship between ownership and control of data. Digital ID and eKYC, designing better systems. Hong Kong, 20 years ago, the octopus was amazing. 20 years ago, our smart ID was pretty amazing. Today, not so much. And we're a lot smaller than India's 1.3 billion, just 7 million people. But the mainland and others in the region have already moved ahead, Singapore, Australia, not the least, and it's something that we have to look at very importantly. What are we doing here? As you all know, the developments in the innovation context, Dreamcatchers, iDendron. Many of our most promising student startups are in the FinTech area. Young people are excited about these areas. We're seeing very interesting collaborations between finance students and engineering students, and I'm always having to remind them that they might need a little license for that. And so law becomes important. Our first Hong Kong U FinTech Day across the university with support from academics, teachers, as well as students. New degrees. Our undergraduate degree in FinTech will start taking its first students next year. New postgraduate degrees, particularly from the business school and engineering department. Research, this is an area where an increasing number of existing staff, but also new hires, have a strong interest. AI, blockchain, data analytics, cybersecurity, mobile internet, regulation, and policy. Examples of some of the things my team has been working on that we've been talking about today, and something that we think is particularly exciting, which is Asia's first FinTech online course, which will launch with edX the online education provider, on the 15th of May. So I've covered a lot of ground. I'm very happy to take questions either now or afterwards. But in the interim, thank you for your attention and your support.